A higher dividend often sparks excitement, sometimes even concern, among investors, especially when it coincides with a year of softer profits. That's why Wilcon Depot's decision to raise its 2026 total cash dividend to 0.40 pesos per share stands out. At first glance, some might assume this jump is a reward for booming earnings, but a closer look tells a different, more nuanced story. Wilcon's recent results were mixed. Net sales for the first 9 months of 2025 edged up by 2.6%, reaching 26.34 billion pesos. Yet, net income declined almost 12%, and margins narrowed noticeably. Management attributed this dip to higher costs, mainly from ongoing expansion. Wilcon sold more, but it earned less from each peso, hardly the textbook formula for a roomy dividend hike. So, what gives Wilcon the confidence to boost its payout? First, Wilcon is drawing from a substantial reserve of unrestricted retained earnings, profits accumulated over past years and explicitly designated for dividends. By the end of September 2025, nearly 8 billion pesos was available for dividend declaration. The new payout, totaling roughly 1.64 billion pesos, is well covered, nearly 5 times over, by these reserves. It's a clear sign the company is using existing strength, not stretching beyond its means. Second, operating cash flow remains a pillar of support. Despite margin pressures, Wilcon generated 4.25 billion pesos in net cash from its core business in just 9 months. This provides ample real liquidity to fund the 2026 dividend, backed by over 1.7 billion pesos in cash and short-term investments at quarter's end. Third, Wilcon's balance sheet is healthy and conservative. The company is bank debt-free, maintains a strong current ratio, and shoulders manageable liabilities. It retains the financial flexibility to invest, pay its leases, and return capital to shareholders without compromise. But it's important to notice the structure of this year's payout. The regular dividend is slightly lower, but the special dividend increases the total, signaling management's willingness to reward shareholders from accumulated gains, not just recurring profits. Still, investors should be cautious. Inventory is rising, cash has dipped from prior highs, and future dividend growth may rely more on past retained earnings than on accelerating current profits. This approach is sustainable for now, but not a permanent substitute for stronger operational momentum. Ultimately, Wilcon's 2026 dividend increase is not a celebration of recent earnings. Instead, it's a message. Robust reserves, reliable cash flow, and prudent stewardship allow the company to deliver meaningful returns, even in complex years. For investors, that's a reassurance grounded in financial reality.